What if I told you that the biggest threat to financial markets isn't artificial intelligence? It's not trade wars, it's not inflation, and it's not even the decisions coming out of Washington. Instead, the risk hiding beneath the surface begins in a country many investors stopped paying attention to years ago: Japan, a nation famous for anime, bullet trains, and sushi. But behind all of that lies one of the most important financial experiments in modern history. And that experiment may finally be coming to an end. If you've been wondering why mortgage rates remain stubbornly high, why the stock market feels increasingly fragile, or why central banks seem to be losing control, the answer may lead us to one of the most boring financial assets imaginable: Japanese government bonds. It sounds dull, but by the end of this video, you'll understand why decisions made in Tokyo could influence everything from your retirement account to the price of your future home, and why some investors are quietly preparing for one of the biggest shifts in global finance in decades. So, let's begin. To understand today's risks, we need to go back over 30 years. The late 1980s, Japan was unstoppable. Its economy was booming, its companies dominated global markets, and its real estate prices became absurd. People joked that the land underneath Tokyo's Imperial Palace was worth more than the entire state of California. Investors believed prices would rise forever. They were wrong. In the early 1990s, Japan's massive asset bubble burst. Stock prices crashed, property values collapsed, banks were left drowning in bad loans, and the economy entered what would later become known as the lost decades. Years became decades. Economic growth disappeared. Inflation vanished. Wages barely moved. Japan became trapped in a cycle of stagnation, and policymakers became desperate. The Bank of Japan tried everything. They lowered interest rates again and again until rates approached zero. When that wasn't enough, they went below zero. Imagine lending money and actually paying someone for the privilege. That's essentially what happened. But the Bank of Japan wasn't finished. They introduced a policy called yield curve control. Sounds complicated, but the idea was simple. The central bank promised to keep long-term interest rates extremely low, no matter what. If markets pushed rates higher, the Bank of Japan stepped in and bought more bonds. They became the market. And for years, it worked. Japanese government bonds paid almost nothing, which created an unexpected problem. Investors needed returns, and Japan wasn't giving them any. So they looked elsewhere. Imagine you're running a pension fund in Japan. You manage billions, but local bonds yield close to zero. You have two options: accept tiny returns or invest overseas. Most chose the second option, and over time, Japan became one of the largest suppliers of capital on Earth. Japanese investors poured money into American Treasury bonds, European debt, global stocks, real estate, corporate bonds, emerging markets. If there was a promising investment somewhere in the world, Japanese money probably helped finance it, slowly and quietly. Japan became the financial plumbing of the global economy. But there was one strategy that accelerated everything. A strategy so powerful it created trillions of dollars in global liquidity: the yen carry trade. Here's how it works. Let's say you can borrow money in Japan at almost 0% interest. You borrow 1 billion yen, convert it into dollars, then buy U.S. Treasury bonds paying 4 or 5%. You keep the difference. Simple. As long as Japanese rates stay low and the currency doesn't move against you. For years, this strategy looked almost risk-free, and investors didn't stop with government bonds. They bought stocks, tech companies, real estate, private equity, everything. Cheap Japanese money flowed everywhere. Global markets became addicted to it. Liquidity surged, asset prices soared, risk-taking exploded, but every financial system built on cheap money has one weakness. It assumes cheap money lasts forever, and forever eventually ends. After decades of near-zero rates, inflation finally returned to Japan. Prices started rising, wages began increasing, and suddenly, the Bank of Japan faced a different problem. Inflation wasn't too low anymore, it was becoming too high. So policymakers did something many investors thought impossible. They raised interest rates, and then they signaled that more changes could come. It was a historic moment, because for the first time in years, money in Japan was no longer free, and markets noticed immediately. Investors who borrowed cheaply in yen suddenly faced higher costs. Currency risks increased. Hedging became more expensive. The math changed. And when the math changes, money moves. For decades, Japanese capital flowed outward. Now, some of it may flow back. This process is called repatriation. It sounds harmless, but its consequences can be enormous. Imagine you're a Japanese investor. You can suddenly earn more at home. Why take extra risks overseas? Why buy American bonds? Why buy foreign stocks? Why expose yourself to currency fluctuations? You simply bring your money back, and if millions of investors make the same decision, the effects spread everywhere. Treasury demand weakens, bond yields rise, financing becomes more expensive, liquidity tightens, and suddenly, an event happening in Tokyo affects homeowners in Texas, investors in London, businesses in Germany, and families around the world. Many people believe central banks control all interest rates. That's not entirely true. The Federal Reserve controls short-term rates, but long-term rates, those depend heavily on investors, on supply and demand. If fewer investors want government bonds, yields rise. It's basic economics. And here's the problem. The United States is issuing enormous amounts of debt, trillions, every year. That debt needs buyers. For years, Japan was one of the most reliable buyers. What happens if they buy less? The government may have to offer higher yields, which means higher borrowing costs, not just for governments, but for everyone. This isn't just a story about bonds, it's a story about everyday life. Mortgage rates are heavily influenced by long-term treasury yields. If bond yields stay high, mortgage rates stay high. That means homes become less affordable. Monthly payments increase, fewer people buy houses. Housing markets slow down. The same thing happens to businesses. Companies borrow less, expansion slows, hiring weakens, investment falls, all because the price of money rises, and that's why bond markets matter, even if most people never think about them. High interest rates affect stocks too, because when investors value companies, they estimate future profits, then discount those profits back to today, and the discount rate often depends on bond yields. When yields rise, future profits become less valuable. Valuations shrink, especially for growth companies, companies promising profits far into the future. Suddenly, investors become more cautious, risk appetite falls, market volatility increases, even if company earnings remain strong. This is why stock markets sometimes struggle even when economic headlines seem positive. The cost of money changed, and everything must adjust. Here's the uncomfortable truth. For decades, the world benefited from an unusual situation. Japan kept rates near zero. Capital flowed freely. Liquidity expanded. Asset prices climbed. Investors became accustomed to easy money. But financial systems evolve. The conditions that created yesterday's winners may disappear tomorrow. And if Japan continues normalizing policy, the world may need to adapt to a future with less liquidity, higher borrowing costs, more volatility, and fewer safety nets. This doesn't guarantee disaster, but it does mean change, and markets often fear change more than anything else. The biggest risks rarely make headlines, they're rarely obvious, and they almost never arrive with warning signs flashing in red. Sometimes, they're hidden inside complicated markets, boring assets, and countries investors stopped paying attention to years ago. Japan may not dominate the news cycle, but its decisions could influence the future of global finance, because money moves quietly, until suddenly, it doesn't. And when the world's biggest source of cheap capital changes direction, Everyone feels it. The question isn't whether markets will notice. The question is, will they notice before it's too late? If you enjoyed this video and want more deep dives into the hidden forces shaping the global economy, subscribe. Because sometimes the most important stories are the ones nobody is talking about until they become impossible to ignore.